Is there any upside to inflation?
Yes.
There is.
I love it.
You,
I'm telling you. I'll tell you why. Go ahead.
well, I didn't expect him to say, I love it.
I always talk about the safe risk ratios with clients if they're going to invest money.
Yes.
Someone has $500,000 and what percentage are we going to put in risk type accounts, stocks, bonds, mutual funds and stuff? How much are we going to keep in safe stuff?
Sure.
And I've always talked about when we have inflation, we have interest rates that start to go up. The good interest rates like savings, checking, and money markets and all that stuff. CDs. Well, insurance companies, those are the safe products I use. I use fixed annuities and fixed index annuities. So insurance companies tend to be more proactive. Once the Fed starts to raise rates, they raise their rates. 3-4 years ago, like a 5-year fixed annuity was paying 2.3%, 2.6%. Just today, I can get a 5-year 4.5%.
Welcome to Today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Anchored in family values, Wayne offers practical advice to help you get the most out of your retirement years. For more information, visit today'sretirees.com. Now, here's your host.
And welcome to Today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Have you been watching the news? Every time you turn around, Wayne, it's the inflation.
Talking about what a woman is or inflation? I don't know.
I think we're talking about inflation
Okay,
today.
I gotcha.
But was it just this past week, they said the new rate is 9.1%. Now, I also read that this 9.1%, if they figured it the way they used to figure it 20 years ago, would be like 15% or something. But anyway, it's 9.1%, the inflation rate, the worst inflation we've had in 30 years or something like that? What is this doing to our investments, our portfolios, our estate plan, our financial plan?
Yeah, and we talk about inflation on this show, quite a bit. And yeah, I almost hesitate to talk about it again, but it's just like, we got to talk about it.
It's everywhere, yes.
Because people are worried about it. And, my belief was always it's transitory, it's a temporary. I didn't think it would be going on this long. But, it is likely to start pulling back, especially with the Fed raising rates aggressively. Supply chain is getting better. So, I heard wages were dropping too this week. I don't know if you
haven't heard that.
Yeah, I heard that pretty significantly in certain areas. But I wanted to see how the listeners and viewers are handling the inflation. Is it causing them to change their lifestyle?
Oh, sure.
That's are they not doing certain things? So some folks have no choice. They have to drive to work. They have to put those miles on the car. They have to buy certain amounts of food to survive. And some of those folks don't have a lot of money.
Sure.
So I'm not talking about those people. This show's about investing and retirement planning, financial planning. So typically, it's geared for people that have money.
Sure.
Not that people that don't have money typically won't listen to this type of show or watch it. They don't care. People that have money, however, and I caution people that if you have money and certain things are going to cost more, like a tank full of fuel, driving on your vacation, and that you should still do that stuff. If you've done your financial and retirement planning and you're financially sound, you don't want to not do those things. I mean, that's part of life and living, and we don't know how long we're going to be alive, right? We don't know that. We don't know how many healthy years we have in retirement. If you're in your 60s or 70s, how many active, healthy years are you going to have?
Right.
So if you put that stuff off, you may not have a chance to do it again. The trip to Alaska or the vacation to wherever. And I just had a client last week or 2 weeks ago that he was going to cancel his trip to Michigan. Not Michigan, Minnesota.
Oh, okay.
Minnesota is a little farther to see his family. And I'm like, you got the money.
Right.
Your income's fine. You have plenty in the bank, plenty in checking, plenty in investments. You're not even dipping into your investments.
Okay.
You've been retired for how many years? You haven't dipped in there at all, other than the required minimum distributions. Let's take some more out and go on your vacation. That's why you saved it.
Right.
So I do want people that can comfortably, easily afford to continue living their lifestyle and having to pay more money to do it, do it.
Okay.
Okay. If you can't, that's a different story.
Sure. But it's a mindset.
It's a mindset.
And as you get to a certain age, whatever that age is, you have a sum wherever that's invested, or your accounts. For some, I'm sure that's I want to make sure that that's still there, and it gets into your head more than.
I mean, if you're working with a certified financial planner, a good financial advisor, they've projected this in inflation and unexpected. This is just like a furnace going out in your home or an AC unit.
Sure.
You're going to spend an extra $3,000 to $5,000 this year that you weren't planning on it.
Right.
Hopefully, your financial plan can absorb that.
Right.
It's going to be temporary. All inflation is transitory. It's just what's transitory?
Right.
6 months, 12 months, 18 months.
Okay.
An average recession, which I don't think we're in yet, but the average recession lasts 11 months. So you got to get through that period. If you have the funds, you want to try and not put your lifestyle on hold if you have the funds.
Sure.
This is my personal opinion. I've seen too many people put things off, and then a health situation happens to one of the spouses, and now it ain't going to happen.
No, they can't do it.
Right. So if you just want to think through that stuff. I also want to ask people if they're surprised at what's going on. Is this shocking them? I mean, did they not allow for it in their budgeting and their planning for unexpected inflation? Where it wasn't unexpected. Everyone, when the government was giving out all the stimulus, all the $1 trillion packages and everything, everyone was saying we're gonna pay for it at some point.
Right.
So I don't know what the surprise is.
Right.
We're paying for it now.
Right.
Okay, in more ways than one. A couple good things to take from this is if you didn't plan for it, or you're having a hard time getting through this inflationary period, once we rebound, which is going to happen, inflation will come back down, things will go back to normal, stock market will come back up. Make sure you plan for it the next time.
Sure.
If I always talk about your happy number, your savings account down at the local bank. If your happy number that you always keep at the bank is $25,000, and you're dipping into it now because of higher cost of living, maybe we up that happy number moving forward once this rebound happens to $30,000 or $35,000. So when this happens again, you have the extra cushion in your bank to fund the higher gas, the higher fuel, the higher food.
Makes sense.
Learn from it, just like COVID, learn from what we went through there and then plan for it so if something like that happens again, you're prepared.
Well, that's the beauty of working with like yourself. You help that family figure that out and plan for those unexpecteds.
Yes, and learn from going through the unexpected to fix the situation so when it happens again, you don't feel the same stress or worry or pain.
Sure.
You should be going through this recessionary period worry-free, really, if you did your retirement planning properly.
Sure.
It shouldn't be, flash in the pan should be nothing.
Right.
Really.
It should be. And friends, that's why it's important to put together a good financial plan. Call Wayne's office at 866-626-3990. if you haven't already, set up an appointment, go in and see Wayne. Even now, you can look at the second opinions, you can look at what you're doing, and he can help you put together your plan for your family that makes sense for what you want to do and what you need to do. We'll be back right after this.
We've all heard the word rollover when referring to an investment account at work or your 401k, your 403b, your 457 plan. What do you do with that when you've left your job and your 401k or other retirement plan is still at your old employer? Or what if you've retired? One thing you don't want to do is you don't want to leave your money, your retirement account, in your employer's 401k. Quite frankly, your old employer or current employer is the boss of your retirement account. So if you have questions about what to do with your rollover, you roll it to Wayne. Get it in your own hands where you have the whole universe of investments and choices, not just what your employer tells you you can pick from. So contact my office for a free consultation on how to roll over your old retirement account.
And welcome back to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. We're talking about inflation today, and as if you pay any attention at all to what's happening, and this isn't inflation just isn't in America. This inflation deal is going on around the world. From what I'm reading, what the last number was 9%. When folks are watching this, it may be more than that. But is there any upside to inflation?
Yes.
There is.
I love it. I'm telling you. I'll tell you why. Go ahead.
Well, I didn't expect him to say, I love it.
Yeah, it's so I always talk about the safe risk ratios with clients if they're going to invest money.
Yes.
Someone has $500,000 and what percentage are we going to put in risk type accounts, stocks, bonds, mutual funds and stuff? How much are we going to keep in safe stuff?
Sure.
And I've always talked about when we have inflation, we have interest rates that start to go up, the good interest rates like savings, checking, and money markets and all that stuff, CDs. Well, insurance companies, those are the safe products I use. I use fixed annuities and fixed index annuities.
Okay.
So, people still have money at the bank and everything, that's fine. So insurance companies tend to be more proactive. Once the Fed starts to raise rates, they raise their rates.
Okay.
Okay, so, 3-4 years ago, like a 5-year fixed annuity, it was paying 2.3%, 2.6%.
Okay.
Right? Now, and the Fed's only raised rates, a couple times. They're going to raise them again here in a couple weeks, I think, we talked about. Just today, I can get a 5-year 4.5% rate.
Wow.
So that's a 2% increase just in the last few years.
Sure.
That's an extra $2,000 per $100,000.
Okay, sure.
That'll pay for a lot of gas.
Yeah.
So if you can have your safe money earning 2 or 3 or 4% more, my index annuity rates, like the best we can do was 4 or 5. 3, 4, 5 years ago, 4 or 5%. Now we can get 8, 9, 10 with no risk.
Really?
So yes, per 100,000, if you can get another 4%, that's $4,000 a year that you could spend.
Sure.
If you have 200,000 in safe money, that's an extra 8,000 extra over
Right.
and above the 4% you were getting. So if you can get 5, 6, 7, just say 6 on $200,000, that's $12,000 a year. In interest. So if you're an average retired family and you're spending $50,000 or $60,000 a year, and we have inflation, the core inflation is really like 5.
Sure.
It's not 9. Some of the things are higher like fuel and that, but as a whole, it's like 5, 6%.
Okay.
And it's expected to come down before year end, into the 5s, and then next year into the 4s. So it's transitory. We don't know how transitory, but it ain't going to be here forever.
Sure.
But once you get these rates, like that 5-year rate I just told you, you got that for 5 years, and next year inflation's back down to where it was, and you're capitalizing on these new current high interest rate environment.
Gotcha, right.
And if you're living on 60 and you have 5% inflation, right? Normal inflation's 2 or 3, so it's just an extra 2 or 3 core. 3% on 60,000 is $1,800.
Mm-hmm.
Right. If I can get you an extra 3% on your 100 grand,
Mm-hmm.
that's extra 3,000.
Sure.
That more than covers the 1,800.
Oh, yeah.
So savers, retirees, or people close to retire, or people that have money to invest or save, they have a CD coming due, or they have money they want to take from the market, or I wouldn't recommend doing that now, but just say, or they had another annuity that comes due or whatever, or annuities that are out of surrender, they could roll them to these new high rates, and it covers way more than what they're paying in inflation, and they get that for multiple years down the road.
Sure.
It's a win-win.
Oh, yeah.
So I love it.
Wow.
I mean, I wish I had these rates all the time. I'm sure once inflation starts to pull back, these rates are going to go back down to where they were. But, you know, where you think you get 4.5% guaranteed.
Sure.
You know, CDs were paying 1 for 5 years.
Yeah, if that.
Now we get almost 5. And they'll probably be 5% range here in the next month or so.
Right. Yeah, I have a friend who is a vice president of a bank, and I asked her the other day, if you have to, what do they call it, a jumbo, or you have to have at least $100,000, they're paying 0.45.
Yeah.
And
yeah.
You know, on
Get you
100,000.
4.5 guaranteed right now. So
So that's 10 times more.
yeah, and I don't know why the banks lag. You know, insurance companies, you know, those are the financial institutions, and banks. You know, insurance companies don't lend money to lenders like us. You know, bank will pay you, 0.5% on your savings and go charge someone 8% for a car loan.
Right.
You know, but the bank rates will start to come up. It's just the insurance companies are way ahead of them.
Sure.
And we get some great rates now for savers, for people that want money safe and they want to earn, 4, 5, 6, 7% with no risk.
Sure, yeah. And that's that word, no risk.
Yeah, I don't want to get into specific. I'm just talking generalities, today. But yeah, no market risk. And you hear the commercials,
Sure.
Mortosh and all these other guys. But there's products out there from insurance companies that those are the kind of rates you could earn today.
Wow.
And I'm just trying to make the point, with inflation, we couldn't get those kind of rates even last year.
Sure.
And we haven't seen these kind of rates in a long, long time. And the only reason they're available to us right now is because of the inflation we have and the Fed raising rates, trying to, put a slowdown and clamp down on inflation.
Sure, absolutely.
So I don't mind it. People that do mind it are people that got to borrow money.
Oh, yeah.
Right? Or people with variable rate mortgages, or people that are going to go buy a new house now or whatever. I'm talking about savers, no debt, they have money to invest. They should love this inflationary period.
Sure, because, like you say, you're going to get anywhere from 2 to 6% higher
Than you've been.
Than you've been doing.
That'll cover your inflation that you're going to pay, on your lifestyle. It's just, you'll be way ahead of the game.
Well,
they win.
Sure.
Yeah.
Well, it makes sense. And friends, this is why you work with someone like Wayne and put together your plan, he'll help you put that together. But you have to get in touch with him. You can go to his website at todaysretirees.com, todaysretirees.com. You can pick up the phone and call his office, and he'll sit down with you, make an appointment at 866-626-3990. We'll be back right after this.
A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam, at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio.
And welcome back to Today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Today's program, we're talking about inflation. And if you missed the first 2 segments, you need to go back and watch those. One of the things that Wayne told us in the last segment is because of inflation, your return on some of your investments, some of the safe investments that he has, the rates are a lot higher than they have been, 2 to 5 or 6% higher.
Yeah.
Depending on what you have and how much money you're putting in.
What type of product or investment it is, absolutely. But the fact is that they're that much higher.
Right.
And that's money in the saver's pocket.
Sure.
You know, people that want safe money. And, you know, in addition, kind of the opposite of that, we also have a stock market that's low right now.
Right.
You know, so people that do have funds, extra funds, you know, pension rollovers, or they have a CD come due, you know, not only can they get higher rates and safe money, but when you're investing in the market now, when the market's 25% plus down, you're buying right where you want to be.
Sure.
Low.
Everything's on sale.
Everything's on sale.
Right.
You know, most people get afraid, and, you know, not most, but some are concerned or whatever, and then some think they want to get out of the market, you know, because they've down. That's the worst thing you can do.
Right.
Now's the time to put more money in.
Sure.
You know, so if you have money in this inflationary period, which is of course causing the market to come down too, you have an opportunity for safe money to get considerably higher interest rates, and you have an opportunity for risk money to buy in at a low number.
Sure.
So the benefit you're going to reap from those, either avenue you take, is going to way cover the extra you're paying out of your pocket for meat or fuel or energy or whatever now. It's not even, you know, but those, of course, are for the savers, people that have assets.
Sure.
Yeah, I feel for the people that don't. You know, someone living paycheck to paycheck, or, you know, they have a family, they have low income or moderate income. They're hurting. You know, but again, this show isn't geared towards those people. It's geared towards people that have saved.
Sure. And
have been diligent over the years and have a nest egg. Those people are able to take advantage of this current inflationary situation.
Sure, absolutely. Well, let's talk a little bit about what happened. I mean, everything's a roller coaster when we're talking. You know, the inflation's 9% now. Just a few years ago, it was 1%. It's going to move back. And if
come back down, it might go higher yet, but it'll come down.
If we have a good plan, I think maybe that's the key, is planning for this unexpected, or planning for the expected. Maybe that's a better word, because we expect things to change.
Yeah, it'll be the period of replenishment. I mean, we'll be able to replenish the savings we used up. We're going to replenish the investment losses. You know, everything will eventually come back. You know, if you dipped into your savings a little more than usual because of the extra out-of-pocket costs, you know, you're going to have to replenish that and build it back up, and learn that if it was cutting your budget, not your budget, but your comfort zone with taking your savings too low, then we have to build it up higher. So when this happens again, you're not going to get back down as low. You know, you just got to learn from it and know everything's cyclical. The market's cyclical. This is nothing new. The market going down 25 or 30%. I mean, inflation's not new. I mean, with the government spending the way it was, I mean, what people know that government spending, you know, flooding money into the economy like they did, you know, when that money's gone, this is what we have.
And we have seen it historically through the years.
Yes, and with COVID now we've never seen a supply chain issue like this. You know, baby formula and everything. Yeah, but you have a war going on with Putin messing around with the oil, especially to, you know, Germany and them. I mean, that's affecting us here for sure. You got Biden, you know, cutting the licensing for drilling and, you know, stopping the Keystone Pipeline. You know, that's going to have effects on fuel, a war, and all this other stuff. You have big parts of China quarantined that, you we get so many parts and things from China, that's affecting the supply. So we haven't had that kind of stuff before, but things do happen in the world, and you have to be ready for those, and you have to be ready to get through them. And when you're retired, you got to make sure that when these things do happen, it doesn't mess up your retirement.
Sure.
One thing is some people got spoiled in the market, like the last 3 years of the market, 3 years up until end of last year, were great market years.
Right.
So people thought it was so easy to make money. So they would put less money safe or no money safe, and they'd have it all in the market.
Right.
This is great. Double digits every year. Well, they're learning now that doesn't go on forever.
Sure.
So you have to not forget history, what happened in the past, and you got to keep good balance with your investments and your safe risk ratio.
Sure. So when you're planning for this, is there a rule of thumb? I mean, you said cyclical. Does this happen every 10 years, 20 years?
No, I wish it was that,
Wish it was that simple.
I mean, it has in the past with the market pullbacks,
Yeah.
94, I think, and then even before that, we had like 87, that Black Monday,
yeah.
big pullback, and then 94, then the 2000s, and then 2008, it seemed like every 6 to 8 years. But it's since 2008, now we're, came back in 2009.
Right.
And we're how many years? 13 years later. We had a little dip during COVID, March
Right.
of 2020, but so used to think you could plan on it, but no.
Right.
A lot of people did. They got out of the market, said, hey, we're due, and they missed out on a huge amount of gain.
Sure. So it's important, friend, for you to get a plan, work the plan, learn, and this is what, this is just me talking. Wayne can correct me here, but if you have a good certified financial planner, he or she is looking out for all of these scenarios where I am sort of, I just have my little thing, and he's looking at all the various aspects and the pieces and trying to help you put together a plan.
And preparing folks, of what has happened in history and what's likely to happen in the future, and to make sure your money is invested and your plan is set up to where when these things happen, you're not freaking out because you're expecting them, and you're able to get through them without having to change your lifestyle.
Sure.
Sometimes it's hard mentally, like we talked in the beginning of the program, to, I'm not going to take that trip at, say, $5 a gallon, but you give plan for it.
Right.
And take the trip.
Right. And like you said in this a second ago, now is a time of replenishment. As everything is coming back up, you can replenish those funds that maybe you used during that leaner time. So call Wayne, call his office at 866-626-3990. Let him help you put a plan together. We're out of time. We'll see you the next time.
Thanks for tuning in to today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Visit todaysretirees.com or call 866-626-3990 to schedule a no-cost appointment with Wayne. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management, family-focused retirement and tax planning services, anchored in family values. Information and opinions discussed on today's Retirees do not necessarily reflect the opinions of this station. Opinions expressed should not be substituted for individualized consultation with a qualified financial advisor. For specific information, call 866-626-3990 or visit todaysretirees.com.